there are a few fundamental concepts I want to make sure that you understand about managerial accounting before we explore them in more detail in the classroom. And the first thing, and this is very important, cost behavior. Costs can either be fixed, variable, or mixed. So let's talk about that for a second. A fixed cost. A fixed cost does not change when activity changes. So think about this. An example of a fixed cost might be rent. Okay. If you're running a restaurant, let's say your rent is $2,000 per month, you're going to incur a cost of $2,000 per month, whether you sell $50,000 worth of food to customers or $100,000 worth of food to customers. And that's the nature of a fixed cost. So it does not change with activity. A variable cost does change with activity. So with a variable cost, maybe we would say, oh, the best example is miles per gallon, or fuel usage in your car. Let's say that every time you drive your car, you spend 30 cents on gas. That might be a little high, but you get the concept there. That's a fully variable cost. Drive more miles, spend more on gas. So the rate per unit is constant, but in total, the cost increases and decreases with activity. Then you have mixed costs. Mixed costs have both a fixed and a variable element. The best example I can think of there is electricity. So let's say that it costs $30 a month just to have electricity service at your house. Whether you use it or not, it's $30 a month. That's the fixed component. And then on top of that, it's, let's say, 2 cents per kilowatt hour. So there's both a fixed component and a variable component to this particular expense. If you don't use much electricity, your bill is going to be close to $30 for the month. If you use a lot of electricity, maybe it'll be $100 or $200 or something much greater. So these cost behavior concepts are very fundamental as we will explore something called cost volume profit analysis. We're going to look at decisions that need to be made and be able to, for example, let's say you wanted to figure out how many pizzas at a pizza restaurant do I need to sell just to break even. In other words, to have my revenues equal my expenses. That's an important thing to know if you're running a pizza restaurant, because if you sell fewer than that number, you're going to be in the loss area. And I don't know about you, but I'm not in business to lose money. So I'd like to know, what is my break-even point? And then let's set strategies and plans to exceed that break-even point to make sure that we can earn a profit. That's just one example of the way that we will be using cost behavior to make decisions in managerial accounting. As you might recall, one of the primary foci of managerial accounting is to make decisions. And we need to understand that some costs are relevant for decisions and some costs are not relevant. Differential costs are relevant. So in other words, if you have two options and there's a difference in the cost between those two options, that becomes a relevant decision. Let's say that I'm recording this in Grand Rapids, Michigan. Let's say I want to go to Chicago for a concert. I could drive my car, I could take the train. Okay? The cost of a train ticket would be relevant to that decision because it's a differential cost. If I drive the car, I don't have to buy a train ticket. If I take the train, I do have to buy a train ticket. So a general rule is that differential costs are always relevant to making decisions because they differ between alternatives. Sometimes we would call this an avoidable cost. In other words, if I take the train, I could avoid filling the gas tank of the car. If I drive the car, I could avoid paying for the train ticket. Always relevant. Sunk costs are never relevant, even if we want to try to make them relevant, emotionally relevant. They're in the past. They're sunk. There's nothing you can do about them. Take that example of driving versus taking the train. Let's say that I put a license plate on my car. And earlier in the year, I paid for that license plate. That is irrelevant to the decision whether I should take the train or drive. And here's the reason, is because I'm going to put the license plate on the car either way. It does not differ between alternatives. It's not avoidable, and it's in the past. Okay? There's no way it can change in the future. So sunk costs are never relevant to a decision. Opportunity costs are relevant to decisions, but they're easy to overlook because opportunity costs are not usually sitting on a financial statement staring us in the face. It's the cost of the next best alternative. Take this for example. If I take the train to Chicago, what could I do with my time? Well, I could work on a lecture for class, I could grade some exams, read a book, take a nap. These are all things that I could do on the train, but I couldn't do if I'm driving my car. So let's say that the next best alternative on that train would be I would grade some exams. Well, an opportunity cost of driving my car would be I can't grade exams during the travel time because obviously it wouldn't be very safe to grade exams while I'm driving a car. That is relevant to my decision whether I should drive or take a train, but it's not always obvious. So opportunity costs are relevant, but you really have to think about them and seek them out in order to identify what those are. Finally, this. Managerial accounting often is trying to figure out what does something cost, a cost object. A cost object could be a product, it could be a service, it could be a class. Here at Grand Valley, we could try to determine what did it cost for me to produce this video? What is the cost of producing the video? A cost object is anything that you're trying to determine its cost. And we have three basic building blocks for cost: direct materials, direct labor, manufacturing overhead. Now what we're going to say about direct materials and direct labor is that those are easy or convenient to trace to a cost object. So in other words, let's think of an example here. Let's say that it's a car. We're manufacturing an automobile. It's pretty easy to figure out that this car needs 4 tires, and each tire costs, let's say, $100. So the direct materials cost for tires for one car is $400. And it would not be too difficult to figure out how much 1 hour of labor costs, and if we know how many hours or minutes of labor is required to produce a car, we can trace that direct labor to the cost of the car. So direct materials, direct labor can be directly traced to a cost object. The difficulty comes here with manufacturing overhead. Manufacturing overhead is a broad category of items that really are not easy or convenient to trace to a cost object. In some cases, it might be nearly impossible. Take, for example, the automotive factory. So let's say it's a General Motors automotive factory, and they have electricity bill, and the electricity bill might cover some of the office area, some of the production area for this car, some of the production area for this car, maybe shipping and receiving, maybe for maintenance area, janitorial, various portions of the factory. It may not be easy to see how much of that electricity bill should be traced to a particular automobile or line of automobiles that's being produced. So instead what we do is we take costs like that and we put them into a bucket called manufacturing overhead, and then we allocate them to cost objects. And that's where we spend a lot of time in managerial accounting, is trying to determine what is the best mechanism for allocating or sprinkling this overhead among cost objects. So keep this in mind. Those are the 3 basic building blocks: direct materials, direct labor, which are traced; manufacturing overhead, which is a little bit more cumbersome. It gets allocated, but these are terms that we're going to be exploring in more detail when we get together in the classroom.